Well, despite very accommodative policy settings from regional central banks, I still think the global economy remains constrained by its 3D problems, and they are debt, demographics and disruptive technology. And in the second half of 2016 and into 2017, we really don't see that situation changing. At the moment, the global economy is growing at around 2.5%. We tend to think that in the second half of 2016, there'll be a slight improvement, mainly based in some advanced economies such as the US. In 2017, there'll be a little improvement beyond that, growing at around 2.9. That will almost be entirely driven by improvements in the emerging markets. But it's not really a particularly large-scale growth recovery in those markets. Manufacturing exporters still remain pretty subdued. All that's really improving is that the commodity exporters like Brazil and Russia, their growth rates aren't going down any further. And so that automatically leads to a better growth outcome. 2.9% growth would normally be equivalent to around 1% earnings growth, so it's not a lot. Markets are expecting about 9, so I think growth expectations are going to get wound in pretty soon and pretty aggressively. So it's really important for investors to remain focused on those quality assets which aren't overpriced. The most common question I actually get from investors is, well, what's the biggest risk to my investment return? Is it going to be global recession or is it global inflation? And I tend to think that the biggest risk to an investor is global inflation. And the primary reason for that is if we did get significant rises in inflation sustained year in, year out, what that would mean is central banks would have to unwind the policy stimulus and we would see a reversal of the search for yield trades, which have pushed markets up very significantly in recent years. The likelihood of rising global inflation, I think, is pretty low. When you tend to think it, we have a weak growth world, we have falling oil prices, we probably have further Chinese renminbi depreciation, and we also have the impact or the constant impact of disruptive technology. So I don't think inflation really is going to rise much over the next 18 months. By the same token, I tend to think that the global recession outlook is also a very low probability event for two key reasons. First of all, there's still a lot of policy stimulus left in the world. And secondly, because the recovery has almost been so weak, we're not getting the typical build-up of excesses through consumer confidence being too high, taking on too much leverage, and businesses over-investing. Now, those two features just aren't there in the global economy, so I tend to think the likelihood of a global recession in the next 18 months is actually pretty low. Well, overall, I tend to think that we're not going to get significant increases in either short-term interest rates or long-dated bond yields. Again, for two really simple reasons. First of all, inflation in the global economy is going to remain very, very low. It's going to remain around a 50-year low of just below 3%. And at the same time, what we're getting to support bond yields even further is we're getting large-scale asset purchases. So when you look at the three central banks in England, Europe and Japan, they collectively in the second half of this year and into next year are purchasing around $3 trillion worth of bonds, which is around $1 trillion more than has been issued in those three economies and also the US. And so when we have a world of excess demand for bonds, it tells you that bond prices are going to remain very high, and so therefore bond yields are going to remain very, very low. And so I suspect we're going to see a continuation of this search for yield trade that has really characterised markets over the last 2 years. Yeah, whilst the global economy's outlook I still think is pretty subdued, I think Australia's actually quite well placed at the moment. We've just had the RBA cut rates down to a record low of 1.5%, and I tend to think they're pretty much done outside some kind of calamitous collapse in China. And at the same time, the Australian economy at the moment is growing at around 2.75%, but the mining investment unwind's taking around 1% off growth, and that process will pretty much be completed by June next year. So I think the odds are reasonably good that in about 12 months' time, Australia's growth rate is going to have a 3 handle in front of it. Less mining investment, and housing construction is still going to add to GDP. So overall, I think Australia looks pretty good. Now, of course, when we're looking at investments in the Australian share market, a lot of good news is really priced into Australian shares. So we're not going to get this universal ratings upgrade, higher valuations, better earnings growth. I think quality business will be able to improve their performance. What we've seen in the latest reporting season, there's not a lot of revenue growth around. Most of the earnings beats are driven by the cost side, but companies have had to beat on revenue, earnings and dividends to get a price re-rating. And I don't think that's going to be a universal story in the next 12 months. I tend to think quality businesses will be able to do it, but overall it's going to be a more difficult trading environment. So I suspect quality companies will outperform, and Australian returns may be positive, but they're certainly not going to shoot the lights out. Well, in the old days of managing a balanced fund, it was all about equities versus bonds. But today, bonds are even more expensive than equities. In fact, bonds have probably gone from being the risk-free rate of return to really being almost the return-free rate of risk. And so investors are always asking me, well, what do I buy to diversify my bond risk, which is a question investors have never had to ask. To me, though, in this market, diversification is not just about bonds, equities, Australia versus global. It's really which asset classes across the whole world can actually help me reduce my risk and give me better long-term returns. And so really that's what the Real Return Fund, which is the strategy I'm involved in, we allocate capital around the world. We can allocate to any particular sector or markets. And so to me, that product really makes sense in this environment where risks are much higher and returns are probably going to be a little bit lower than what we're used to.